Hi everyone. Today I will be walking you through my Excel model on the valuation of KPI Women's Info System Ltd. The goal of this model is to understand the financial performance and intrinsic value of KPI Women's using a combination of historical financial data and relative valuation model. As you can see here on my screen, the Excel workbook is divided into multiple sheets. There the template, income statement, balance sheet, cash flow statement, uh, and then relative valuation. So for today's presentation, I'll be focusing mainly on the relative valuation sheet because this is where all the important valuation metrics are calculated in the threshold. The data used in this sheet comes from the company financial statement. So the income statement, balance sheet, and cash flow statement feed data into the valuation model. Relative valuation helps us compare KPI performance with peers using ratio like EV, EDI, EVA, and the price to book value. These multiples tells us how the market is valued company compared to others in the same industry. So let's now go into the relative valuation sheet and understand how each metric is derived step by step. So now I will open the relative valuation tab. At the very top, you can see the title, title relative valuation of the company name listed. KPIT Humans is our main company and below are beside it. We usually list comparable firms. These could be companies from the same IT services industry, such as Tata Elxsi, L&T Technology Services, or the System System. Now moving across the top now, we see different heading like CMT, number of shares, market capitalization, debt and cash, EV, sales, EB, ITDA, margin, EPS. I'll explain each of these one by one and how their formulas are generated. So first is current market price. Current market price stands for CMP stands for current market price. This is the stock price of KPIT means as of the valuation. It's usually entered manually in this sheet. It's shown in blue because blue indicates actual data from the market. You can here see that in blue color. This is the actual form of data of this company. So, for example, if KPIT full market price is 1,800, that means one share of KPIT is currently trading at 1,800 in the market. So, moving on number of sales. The next column is number of sales. This shows how many equity shares the company has outstanding. This number usually comes from the company annual report and stock exchange. Again, this is actual data, so it's entered manually in here. So you can see this is blue. For example, if KPIT Women's has 26 million shares outstanding, the value is used to calculate the next column, market capitalization. Next is market capitalization. Market capitalization or market cap represents the total market value of the company equity. The formula used here is simple. Total market is equal to C/P multiplied by number of shares. Capital market price multiplied by number of shares. Here, as you can see, is equal to C10 multiplied by the C10 here is in detail. So we get 36,470 million. Why million? Because here you can say all data in millions are in that. What's expect per share price difference. So 36,472 million volume. Next is mm, so this formula gives us how much the market is valuing all the KPI shares combined. For example, if CMP is 1,800 and the company has 26 million shares, this market uh, then the market capital will be 1,800 divided by 26, then we will 46,800 million. This number becomes the foundation of calculating interest expense. Therefore, next is debt and cash. Next, we have debt and cash column. These are also actual value taken from the company's balance sheet. That includes both short-term and long-term borrowing. Cash include cash and cash equivalent. These two values are very important for findings and enterprise value because we adjust market cap by adding debt concept of cash. Next is EV, enterprise value. Now comes one of the most critical metrics, enterprise value, often abbreviated as EV. The formula for EV is EV is equal to market cap plus total debt minus cash. Enterprise value gives us the total value of the firm as if an investor were buying the entire company, both its equity and its debt, while accounting for cash on hand. In Excel, this is usually represented as a calculated flat space. So you can see like since it is a derived value, not an adjusted. For example, if KPI market capital is 46,800 billion, that is 500 million and cash 1,050 million. When you do 46,800 plus 5,000 minus 1,500, then we get to 50,300 million, which tells us that the company total firm value is around 50,300 million. Next is sales. The next column is sales or total revenue. This number is likely directly by the income statement for valuation process and analysis, often used to latest gradual or trailing 12-month sales figure. The formula connection is actually basically pulling data from the income statement sheet. So something like this. So something like um, is equal to income statement. Hmm, 20. Hmm. Here you can see 0.82 is the basically pulling data from the income statement sheet. Sales are used later in research calculations such as EV sales, which helps us see how much investors are paying for each rupee of sales. Second is EBITDA margin, EBITDA. Below sales, we usually find the EBITDA margin. That is earning before interest, taxes, depreciation, amortization as a percentage of sales. The formula of EBITDA margin, EBITDA margin is equal to EBITDA divided by sales. Very clear. Say EBITDA margin divided by is equal to EBITDA divided by sales. So here is the value of time. This figure helps us move forward one of the most important rules, the PV divided by EVI TGA multiple. Second is EPS. EPS, moving on to the EPS for earning per share. EPS tells us how much profit is earned for each sale. The formula is EPS is equal to net profit divided by number of sales. Net profit comes from the income statement and number of sales are already have in our sheet here, the number of sales. Um, Its value is critical because it directly leads us to another important multiples, the PE ratio. So here is the EV, EV, ITD. Now that we have EV and EBITD, we can calculate using EBITD multiple. The formula is straightforward. EBI, EV, EBITD and enterprise value divided by EBITD. Multiple, the multi, the multi, the multiple price. Sales as how many times the company's operating profit before depreciation and tax is valued by the market. For example, he weighs 50,300 and he did ETDA for 5,500 then he did EBI to the is equal to 50,000 divided by 500 9.1 times. So this means investors are paying about 9 times the company annual EBI to buy the entire firm. Values firms in a lower multiple generally suggest that company might be undervalued, while a high multiplier would mean it's overvalued depending on peers. Next is P E ratio. P ratio price to earning. Now we come to the price to earning ratio or P ratio, which is one of the most widely used business metrics. The formula is equal to P is equal to CMP, CMP divided by EPS. CMP divided by EPS. So it tells us how many times investors are willing to pay for each rupees of the company firm. For instance, of if KPI to PNC is 1,800 and EPS is 75 rupees, then G is equal to 1,800 divided by 24 times. PE of 24 means its uh, stock is ratio of 48 of in the first case, we compare with the PE of similar IT companies of peers. Trade of its KPI may be undervalued. Its peers trade of 20x, which may be overvalued. And other values is other values so it present in the page. Sometimes analysts also include the ratio of instance price value with big value or returns equity. These are calculated as easy sense is equal to price value divided by sales. EV is equal to C/M2 divided by book value per share. ROE is equal to net profit divided by shareholder equity. These factors can provide a more conservative shareholder increase. Next is peer comparison and average multiples. After calculating the ratio of KPI to humans, we typically do the same for peer companies. For example, we might calculate PBA video and the fee for data collection like the 220 system. Then we put the industry average or median multiple from sales cost. Once we have that, we can estimate 40 for value by by applying an average multiplier for KPI to not multiply. For example, if the pair was using UBIT to multiply to the peer group is 10, 10x and KPI to repeat the ITDA is 5,500 million. Then say the is equal to 7 into 5,000. To find the fair equity value, we subtract and add price. Equity value is equal to fair value minus debt plus price. Finally, divide by the number of shares to get the fair price per share per, per price. Fair price is equal to equity value divided by number of shares. This gives us the intrinsic per share value based on relative values. If the if the fair if the fair price is higher than the market price, the stock might be undervalued. If it's lower, it might be overvalued. So, lastly, I'm going to do interpretation. Once all calculations are done, our calculated fair value per share is 2001. CMT is 1,200. This means there are an upside potential of about 300, but roughly 70. Based on this, we could say KPI to accuracy. KPI to accuracy undervalued relatives to peer and may offer a buying opportunity. This conclusion, however, should all consider should also consider qualitative factors like KPIT growth, prospectus, client base, or market trends in automotive and IT engineering spaces. That's why relative valuation is a great standing point, but not the only method. We often combine it with this or other approaches for cross verification. So, moving on to conclusion. So, to wrap up, in this Excel model, we have seen how the relative valuation model helps estimate KPI to fair value by comparing it with its peers. We began with basic market depth, share price, and number of shares to calculate market price. Then we added depth and subtracted cash to arrive at the enterprise value. Using ADITDA and PPS, we derived important values and multipliers such as EV, EBIT, by comparing these multiples to the industry average, we could find KPI to fair value and assess whether it's undervalued or undervalued. And undervalued or overvalued. Overall, this approach provides a simple and powerful framework for valuation, especially useful for investors, analysts, and finance students to understand how the market price is. So, something another things you can say here. Financial year 12 and financial year 13, financial year 14 under the EV development. Same as PS, same as under of EVVIT and same as PE under the PE. So here you can say you put in some formulas like how can how it's coming. So 0.95. So G12 divided by H12. G12 and here is H12 divided by, and not forget to uh, freeze with dollar sign. Here you can say after the G and then after the 12. Put in some dollar, then we get this number is 0.94. Everywhere you can do the good formula and fulfill the Excel sheet. So thank you for watching my presentation. I hope this walkthrough helped you understand how you can use Excel to perform relative valuation effectively for a real company like KT, IT, Infosystem, IT. So thank you.